Hi there, it's Michelle Pentecost here from Accelerate Accounting Solutions. And in today's video, I want to talk about investing in property in your SMSF. So it's a question that we get a bit. Can I purchase a property through my self-managed super fund? It's a great question, and it can be effective to build retirement savings, as you can borrow through a self-managed super fund in order to fund a property purchase, which increases the amount that you can invest. But like all investment, it comes with risk restrictions and a time investment. And there's also different rules for investing in commercial versus residential property. But before we jump into the strategy, let's recap what a self-managed super fund is. A self-managed super fund is a retirement saving that you control. Unlike industry and retail funds, where professionals manage the investments for you, you choose the investments and your insurance. A self-managed super fund can have up to 6 members. As a member, you need to be a trustee of the fund, or you can have a company as trustee of the fund, but you would also need to be a shareholder and the director of that company. Trustees are responsible for the fund and investment decisions. There's a couple of tests that we need to look at when we're looking at investing within the self-managed super fund. And the first we want to have a look at is the sole purpose test. So an SMSF must be run for the benefit of providing for members' retirements. And also all decisions that you make as trustee must be in the best interest of the members. So that the decisions must be there to generate wealth for your retirement. The second rule that we look at is the arm's length rule. And what this means is that all investments by your self-managed super fund must be made on a commercial arm's length basis. So this means that you can't purchase an asset at a huge reduction or huge inflation. And you can also not charge an inflated or reduced rent. The purchase and sale price of each fund's asset should always reflect the true market value and the true return. So let's look at commercial property. Under superannuation legislation, commercial property is defined as business real property used within a business. There's difference between a commercial property and a residential property. Is a commercial property, if it is business real property, it can be acquired from a member at market value and rented from the self-managed super fund at a market rent, whether that's to your business or to somebody else's business. It needs to be solely for business use. But you can't buy a commercial building with a unit, a flat upstairs and live in the flat. It has to be purely business use. So a strategy that we see a lot is where we have the business owners, the self-managed super fund purchases the property, it owns the property, and the business pays rent to the super fund. You've got income coming in via rent, it's increasing the value of the self-managed super fund and your retirement properties. In this scenario, the business owners and the trustees can be the same people. The people renting can be the same people, which is slightly different to how a residential property is treated within a self-managed super fund. So the tax consequences from this is that the business can claim a tax deduction for the rent. It can, if it's paying the outgoings, it will claim the tax deduction for the outgoings. Within the self-managed super fund, it receives rent, less expenses, loan interest, property maintenance costs, and any property management fee. All rent within the self-managed super fund is taxed at 15%. So you could be getting a tax deduction for the business if your marginal rate is higher, which it likely is, than 15%. So you're getting a tax deduction at a higher rate and you're paying less tax when it's going into the fund. The other great bonus of having it within a self-managed super fund, tax-wise, is that capital gains are taxed only at 10% where the asset is held for more than 12 months, as opposed to an individual paying tax on 50% of the capital gain where it's held for more than 12 months. And within the self-managed super funds, these benefits get even better once the fund goes into what we call retirement mode, or the members of the fund are entering retirement. But I'll go through that in a bit more detail later. So then we can look at residential property, and this has a lot more restrictions around it as opposed to commercial property. So the first one, in contrast to business real property or commercial property, it cannot be acquired from a member. You cannot sell investment property to your self-managed super funds. cannot lease it to a member, a spouse of a partner of a member, son and daughter, any family member, basically any related party you cannot lease the property to. So the other thing with a residential property, because you cannot lease it to a member, like if you're looking at a holiday home, that would be a bit of a no-no. So that apartment in Noosa that you wanted for family holidays is knocked out under that particular rule. So with the tax treatment, it's similar to a commercial property, except the rent would always be paid by an unrelated party, and it must be a legitimate investment. So the tax applies in the same way, 15% tax on the rent when it goes in. And then if there's any capital gain where the property is held for more than 12 months, it's taxed at 10%. With property, there's a great potential for growth, as we've said in the last 5 years. But I guess like any investment property that you buy, you need to make sure you're buying well and it is a good investment. Capital growth in property can increase your retirement savings, so it can be a very effective strategy. But where this really comes into its own is when you retire and your fund moves into what we call account-based pension mode. And you have to have met a condition of release. So the conditions of release generally is that you're 60 and retired, or 60 and over and retired, or over 65. Once your fund is in account-based pension mode, then any rent that you're receiving into the fund and any capital gains are taxed at big zero. So it's a really effective strategy where you've got big capital growth within property and you're in retirement, you can pay no tax when you sell that property. So what do you need to know about using your SMSF to purchase a commercial or residential property? You'd borrow within a self-managed super fund. It's generally more expensive. There are a limited number of lenders. That's one thing to consider. The structure, if you are borrowing, needs to be set up to purchase the property. One of the rules is borrowing can only be for the single acquirable asset. You can't borrow to purchase property and then borrow to do a renovation. So there's a couple of other things that you need to know about using your self-managed super funds to purchase property. There's the costs. So you do have costs on the setup. You have ongoing audit costs, ongoing accounting fees, and ideally ongoing advice fees. You also need to pay an annual levy to the ATO for having a self-managed super fund. You need to be aware of the ongoing costs and that all trustees are liable for the investments that we borrow within the fund. You need to be aware that it's probably going to cost you a little bit more than if you're borrowing outside of this. And the last thing that I was going to mention here is that regarding cash flow and liquidity. So real estate is a really lumpy asset as opposed to shares, managed funds or whatever, because you can't actually just sell off part of the home or the office space to raise some cash. So you need to make sure that the rent that you're getting, the contributions that are going into the fund are enough to service the loan. In summary, it's important to seek financial advice if you're considering purchasing real estate within a self-managed super fund. Like any major investment decision, it's going to have to align with your retirement goals, and it needs to be a solid investment to begin with. Running a self-managed super fund is a lot of work. You need to provide your source documentation to have your financials done. You need to make sure you're complying. You need to keep your records for 10 years. So you need to put in the time to make sure that you are compliant. So this strategy is not for everyone. It's going to depend on your individual circumstances, but it can really work and work well if you put in the work and you want more control over your retirement savings. It can really boost them up for you. So thanks for watching, and I'll see you next time.